Hello, everyone. My guest today is Chris Ruff. He's an entrepreneur with a passion for new technology and disruptive business opportunities. His executive leadership career spans over 25 years in software, mobile, and IoT industries, focused in the areas of management, business development, marketing, operations, and finance. Today, he's building Glympse to provide last mile visibility. Chris, you ready to take us to the top?
I am.
All right. Talk to us about Glympse. What's the company doing? How do you guys make money? What's the revenue model?
Yeah, so Glympse historically was a consumer application company. We still have millions of users who use our app, but we were unable to monetize those consumer app users. So we took the platform and are now monetizing it by helping customers provide better services in last mile. For example, visibility on when your cable service tech person will actually arrive instead of just a 4-minute window.
Yeah, or a 4-hour window.
4-hour window, excuse me.
I was going to say 4 minutes. I would be okay with that, but it's like sit at your house for 6 hours and wait for us to maybe appear.
Yeah, we take all the discomfort away from that transaction because even if you're having to wait, you actually might be able to run to the store, take a shower, any of those activities that you're now nervous you're going to miss your appointment.
Yeah, be productive in some degree, right? All right, exactly. Very good. And so is this is there any hardware component to this, or it's all like online software?
It's all software. We have a standalone solution that works on a mobile phone that the service tech or the package delivery person will use to share their location. And then we provide all of the notifications and alerts and trigger the updates along the journey to the customer.
Okay, and how are you making money? You're selling directly to me or through a partner?
No, we sell directly to the enterprise. And they'll either pay on a per truck basis, but a lot of our new business models are on a per job. A lot of businesses like grocery delivery are in their infancy, and so they want to pay up the scale as their volumes increase.
So just to be clear, are Instacart's your customer, or Whole Foods your customer, or the person using Instacart at Whole Foods is your customer?
So our customer would more likely be the retailer, and we would be helping them provide their own service. They may still use Instacart for some, but a lot of retailers and grocery and, of course, all of the field service and home service tech companies all provide their own fleets.
I see. So this is like, if you don't want to pay Instacart their fee, Whole Foods, just use us directly. We can be your internal white labeled solution.
Correct.
I see. Okay. So what might a Whole Foods pay you on average per year for this? What's your average customer pay per year?
Well, so it really depends on the industry. And we have the model varies between 15 to 20 cents a transaction for us, because we're just software. We're not actually providing the labor. They're still handling that all themselves. So we're really just the CX consumer engagement tool.
Okay, you said 15 to 25 cents per transaction?
Correct.
Okay, so you're almost like a payment gateway then?
Well, that's not the right way to look at it. We're providing the transactional benefit. We're tracking the product and the delivery all the way through the solution. It's not really a gateway for payment.
Okay. How many retailers are you working with right now?
I can't disclose that. Today we've got several, but we haven't announced them yet.
Okay. I mean, you don't have to be specific. Are we talking like 5 or 5,000?
No. We're dealing with the largest of enterprises. Glympse today only has about 30 customers total.
Oh, perfect. Got it. That's what I want to know. So you're a high touch, high volume business. Yeah.
Yes, we are not SMB at this point. We are purely focused on the largest companies in the world. The ones I can disclose in field services like Charter Communications, True Green. We've announced a partnership with AAA.
That's great.
So we deal with high volumes and big opportunities.
That's really helpful. Okay, so what would you say? Like you are not valuable unless someone calls you as a potential customer and they're doing at least X amount of transactions per month.
Well, it would there is high transactional volume, probably a minimum of 1 million.
Okay.
But we've recently gotten involved in million a month. But we've recently gotten involved in businesses with let's say higher touch, where missing an appointment would be valuable. Maybe you're
like a salon.
You're $1,000 worth of furniture that needs to be assembled, and you want to make sure that the crew to assemble it is there on time. Otherwise, there's penalty, or if the furniture doesn't get there when the people are there, there could be huge penalties. And so in those areas, we can do low volumes, but at very high value.
Okay, got it. All right, put this all on a timeline for me. When did you launch the company? What year?
Well, the company is 11 years old. Started out for the first 8 years of its life as primarily a consumer company.
So just to be clear, this was launched in the middle of the financial recession, 2008?
Correct.
Okay.
And then basically, it's not a pivot. It was an expansion of the platform into enterprise 4 years ago.
Okay, and is this your baby, or did you come in at some later time?
No, I came in a year and a half ago to sort of accelerate the enterprise side.
Okay,
the founder moved into the chairman's role, and I'm taking it the next phase of enterprise growth.
Did you come in as like you were an EIR at a VC? The VC led whatever round you did last, and you came in that way, or no?
Well, no. The founder and I were colleagues, and I was doing some consulting work for him in the board, and we all just came to an agreement that working together would be better, given my expertise in enterprise and telecom and things like that.
So, have you guys bootstrapped, or have you raised to date?
We've raised capital to date.
Okay, how much have you raised?
Trying to think what's been disclosed.
Well, hold on, I can just look it up on Crunchbase if that's easier.
Yeah. About 30 million.
Okay, all equity, or is that equity and debt?
All equity.
Okay, that's great. Okay. Now, was any of that raised while you kind of led those rounds, or that was all raised prior to you?
All prior to me.
Okay, so how did that make you feel joining a company with kind of 30 million bucks? You obviously knew the board dynamic because you were consulting there.
Yeah, so it's so I love I'm a capital efficient entrepreneur. And so I built a previous company during the recession. It was a company called UI Evolution, which is now called Zevo.
Okay.
And we built that company raising less than $15 million, and it's now a leader in automotive technology. So I actually love a challenge of being pretty capital efficient, which makes me the right person to sort of get this to the next level.
Yep.
Glympse will need more capital, but after 11 years, it's really time for the company to prove its business model.
Yep. No, that makes sense. You remind me, yesterday we just had the guy on that's running Mojio, and he's raised about kind of 40 million, and they're doing kind of car telematics thing, and they've driven all the costs out of there.
Joe.
Oh, good. Yeah. I mean, they've driven all their costs out of their model. It sounds like you're potentially thinking about, how do you do the same thing, increase margin?
Yeah, and really learn to scale it, right? Because we have a really compelling business offering, but as you probably know, most small businesses struggle with getting scale working. You can have a great idea, but if you can't figure out how to get it into the market in an efficient, cost-effective way, it doesn't matter how good your mousetrap is.
So how have you landed? I mean, what is your mousetrap today? How have you landed your first, call it 30 customers?
Well, I mean, basically by focusing on where our customers' consumers get the most benefit. So obviously we launched in things like cable because that 4-hour wait window is just painful. And given that cable companies today are experiencing customers leaving for other over-the-top solutions, they want to be the best they can be at delivering service. So we become a really valuable component. On the way, we've expanded the product to actually provide a significant more value. So today, if a consumer opts in for notifications, they get a great Glympse experience. But if somebody doesn't want their service provider to send them text messages, they can still call into a call center.
Oh, so it's not an app. You're delivering these things. You're by texts.
Text or email or in-app notifications. It's all web-based. So integration is super simple.
Yeah, no, that's great.
But we're now integrating, giving ETA to an IVR system. So if somebody called a call center, instead of having to talk to a human, they could say, "Hey, I bet you're calling about today's appointment. Your service will be there in 1 hour." Right? So we could still add a ton of value to the enterprise and provide what's most important, a really great solution.
What's the team size today? How many people?
A little over 30.
Okay, and the last round, how many years ago was that?
Before I got here, so over 2.
Over 2. So, I mean, look, the reason I ask is anyone that's like on the venture path, you're like on the venture path, and there's kind of expectations. And if you're hitting those expectations, usually it means you're raising capital to some degree every 2 or so years. Are you guys raising right now?
We will be raising capital this year.
Okay, and why is now the right year for you guys specifically to do it?
Well, we've hit the point where, for the most part, all of the team dynamics, restructuring, getting the team in place, that was my number one objective, is all fully in place. Number 2, we've expanded beyond cable and ServTech, which are, I always say, those are the appointments nobody wants to have, as opposed to the appointments you actually want to have, like grocery and food, which we haven't announced yet, but we're in those categories. Those are going to give us a much higher sex appeal in the market because those are daily or weekly transactions.
Yep. And what do you think you will be valued on? The total transaction volume or appointments going through you, or your cut, your actually kind of gross revenue that you take per transaction?
Yeah, I think today it's about our transaction growth. We're doing almost 250,000 transactions a day as a company, and so so we're getting tons of scale out of that. And also, because our customers are enterprise, we're really solidly enterprise grade at this point relative to a lot of competitors.
Yeah. So just to go back to earlier, what you said really people need to be doing 1 million in terms of transaction volume, number of transactions with you per month earlier, right?
That's our average customer size. That's where the sort of the not average. It's sort of the call it the 25th percentile. We have a few smaller, but it's to get a ton of benefit out of us. At a minimum, it's 3 million a year, and average is probably 6 million a year to 12 million a year. Yep. And then we've got customers who are going to be in the 25 plus.
Yeah, no, that's great. I mean, look, if you're doing 250,000 in transact, well, first off, that's incredible. I assume that's great growth. Otherwise, you wouldn't have said it. So if you're doing 250 today, right? Today, what were you doing a year ago?
It's double.
Oh, you've doubled year over. Okay, that's fantastic. Yeah. All right, so you doubled year over year. So if you're doing $250,000 transactions today, right, daily across 30. And if you multiply that obviously out and get a month, you're doing about 7.5 million transactions per month across your 30 customers.
Correct.
Yeah, that's great. Okay, and minimum, you said 15 cents per transaction earlier. So 15 cents times 7.5 million is about 1.1 million a month minimum that you guys are doing. You're above that, right?
Sure. Yeah.
Okay.
Yeah, the math's pretty close.
Yeah. Okay. That's good. That's good. Is there anything else I know a lot of times in these businesses, there other kind of revenue streams pop up because you realize, oh, we have this data that's interesting, or no, are you really pure play per transaction, 15 to 25 cents? That's it.
Yeah. Today we are staying really pure play. My belief is focus is best. The other thing is we've been very cautious. In fact, on our consumer side of our business on location, we basically wipe out any identifiable location data from our consumers.
Okay.
And so we've taken a really strong stance on privacy, and we think that's going to also serve us well long term as we get into to enterprise businesses and things like that.
Interesting.
So we're not going to sell our data. And I'm approached almost daily now that some of the wireless operators are reducing their data sales to sell mine, and we won't do it.
Yep. That makes sense. Talk to me more about how you measure things like churn and retention and expansion opportunities.
So most of our customers are on multi-year contracts. I haven't had to deal with much churn.
Okay.
So our customers are 2 to 3 year contracts because they're large enterprise. Nobody wants to jump into a relationship, invest in getting the integration and everything working great, and then opt out the next month.
What about gross revenue churn? So you also capture like if someone does less volume on you now these days. Do you have any gross revenue churn or no?
No, at this point, a lot of our service businesses, if there's any gross loss, it's under 5% seepage, and then a lot of our new businesses in last mile and retail, grocery, and others are growth businesses. So as the markets are evolving, they're doing more transactions every month over month. So we haven't experienced any of that, and it's part of what I love about where our company is we're the consumer expectation around how goods and services are going to be delivered is becoming way more omni-channel. The other thing that we've launched and is in pilot with our first customer is buy online, pick up in store. So this concept of I can track the consumer coming to the store. And you could imagine in the grocery business that gives you at the last minute a chance to go pick up the hot chicken or the cold ice cream.
Not just groceries, but like I'm in Sweet Green in New York. Like I'm always trying to order, and the mobile ordering there is so dependent on when the consumers walk in. So like I could see even the Sweet Greens that need to figure out like how do they balance the meals they're making for the in-person line versus the online line.
Yep, and we're going to be a leader in that space.
Yeah, no, that's great.
Platform.
It seems to me that it make perfect sense for you to obviously get into that. So okay, good. So no gross revenue churn. Talk to me about the opposite of churn, which is expansion. What are you expanding contracts at usually year over year?
On a per customer basis?
Yeah, like on a cohort basis. Yeah.
It's trying to think how to think about that.
Or don't tell me something that you don't measure yourself, because I don't want to force you to tell me data that you don't care about. I mean, do you care about net revenue retention?
Not yet, no.
Okay, guys. So maybe it's too early for that stuff. So let's go past it.
So when you have a density of customers, you're really modeling capturing new large customers as the number one. Now, over time, we're going to see that our base is not large enterprise customers, and we'll be pushing down into mid-market. Yeah. Once we start pushing down to mid-market, more SaaS metrics are going to drive our business. Yeah. But today, it's kind of binary. You win or lose.
Yeah. And what do you spend now to like sign up one of these new 30 partners you have? I mean, do you know what like fully weighted CAC is on that or no?
No, because we don't track it like a SaaS metric because it's pure biz dev at this point.
Yeah.
I've got my sales team does 6 to 8 deals a year. Yep. It's not so my cost of sales is travel and
well, that's fully weighted. That's what I mean by fully weighted. Yeah. Yeah. So, it costs you it costs you like $1 million to sign up a new partner or what?
Nowhere even close to that.
Okay.
Nowhere even close to that. It's probably 40 to 50K.
So if you go raise, I mean, it sounds like this business doesn't need a lot of money. So you're going to go raise this year. Why raise? What are you going to spend the money on?
Well, we've got some product development needs in curbside and the things that we want to expand into. And as you know, hiring technical talent is my costs there are growing.
Yeah. Where are you based?
Seattle, Washington.
Oh, okay. Yeah.
So we pay about as high outside the valley. We pay about as high for human capital as anywhere in the world.
Yeah. All 30 folks are in Seattle.
No, I have biz dev remote.
Okay. And last question.
The tech is here. Tech is primarily.
Last question before we wrap up. Are you prepping the company to raise so that you have the most leverage? What I mean by that is, are you getting to break even before you go out and start to raise, or are you still burning a bunch of cash?
The part of the goal of before raising was to get the company in managing its cash, and I don't know that I'll get it pure to break even.
Yeah.
But we will be in a strong position managing our cash at that point.
So I'm going to try and quantify this without making you uncomfortable. I mean, if you're burning less than $100,000 per month net burning cash, is that a point where you say, okay, we're close enough to break even, we have leverage?
Yeah, absolutely. Because growth businesses, I would argue you never actually want to break even until you hit scale.
Well, you do when you're having raising conversations around valuation. You don't want the investors to feel like they've got leverage on you because you're about to go out of cash.
But 100K is you're in the ballpark of
break even.
That's easily controllable, right?
Yeah. Well, I mean, I don't know, by the way. I don't know if all your costs are fixed or variable.
Yeah. You can slow marketing spend, you can slow hiring, you can do all kinds of stuff. And because we have transactional growth, a quarter of holding costs, flat, we'll actually probably be able to exceed through it.
Yeah.
If we had to do that.
And what, again, I'm asking you because you've done this a couple times at this point. Don't tell me obviously what you think you're going to end up at, but just for you at a personal level, what valuation would make you really happy if you're able to raise at it? Obviously say something way higher than what you'd want, but I'm just curious what would make you happy.
Yeah. I think given our growth and our monthly forward, we'd be really happy at just north of 100.
Yeah, like something like 105 pre, something like that. And it sounds like your run rate right now is like 12 or 13 million something. Yeah, that's good.
So
cool.
and because we're growing on a month over month basis, we can project 12 forward, and pretty soon you get into not even aggressive multiple to get there.
Yeah, no, that makes sense to me. All right, let's wrap up with the famous 5. Number 1, what's your favorite business book?
Ooh, favorite business book. God,
it's okay. No, we can pass if you don't have one on the top of your head.
No, keep going.
All right, number 2, is there a CEO you're following or studying?
I like watching Microsoft's new CEO. He's done an amazing job pivoting that company around.
Satya Nadella.
Being in Seattle, that it went through a pretty dark time, and now it's really humming. It's cool to see.
Number 3, what billing tool do you guys use?
Billing tool?
Yeah.
We don't. I mean, we're basically a QuickBooks accounting shop.
Yeah, because they just pass through revenue.
Customers, it's not hard to do.
Number 4, how many hours of sleep do you get every night?
6.
And what's your situation? Married, single, kids?
Married with 3 kids.
Oh, okay. Wow, you're a busy guy. And how old are you?
47.
Well, you had to think about it. 47. Last question. What do you wish your
I try not to ever think about
myself. Yeah. What do you wish your 20-year-old self knew?
What my 20-year-old self knew? Interesting. That that hard work does pay off, but it takes longer than you think.
Guys, hard work does pay off, takes longer than you think. Building Glympse, founded in 2008. He came in about a year and a half ago after consulting with the board for a while. What they do is, again, they help these brands, right? Like a Whole Foods or like cable companies like Spectrum, make sure that they give consumers a more accurate vantage point in terms of when that service provider is going to show up to the house to do the repair. The way that they make money is they take between 15 and 25 cents per transaction. They're spanning 30 kind of enterprise brands they work with right now, doing over 7.5 million transactions per month right now. That's up 100% last 12 months. So doing about north of 1.1 million bucks per month right now in terms of revenue. Again, 100% year over year growth there. They raised 30 million bucks to do it. 30 people in Seattle, burning, call it, and trying to work towards basically getting to break even, so they can go out and raise additional capital. Hopefully, maybe at $105-ish million pre-money valuation, but we will see. All right. Thank you so much for taking us to the top, Chris. Appreciate it.
Thank you.